Good. Good. So, we are looking at this question, and I'm saying this is product mix decision. Product mix decision, that is what we look at. And the question says, describe the key observation. Actually, it should be the key consideration, not the conservations. Describe the key consideration that should be applied in presenting information for product mix decisions when capacity constraints exist. So the answer to that, part A, the key consideration is contribution margin per unit of the key factor. That is what we call the key consideration, the key factor that we check for us to be able to make that conclusion. So that is all, and you get your 4 marks. Now, part B says, Lego Limited manufactures 3 products, namely A, B, and C. The data below relate to the 3 products. We have the selling price, the variable overheads, the labor installation, labor manufacturing, raw materials. Additional information is highly skilled labor is required for installation for the 3 products in the customer's premises. A maximum of 25,000 hours of highly skilled labor are currently available at 8 per hour during the production period. Fixed costs for the production period are 8 per hour during the production period. I think there is something there. Number 2 should not read fixed cost. It should read labor cost. Number 2 should read labor cost for the production period as shillings 8 per hour. Labor cost. Then number 3 reads fixed cost for the production period as shillings 450,000. The maximum demand for products A, B, and C are 2,000, 3,000, and 1,800 units respectively. Required, the current shortfall in highly skilled labor hour at maximum demand. So let's deal with the highly skilled labor hour. We are now in part B. Highly skilled labor. Now, in the highly skilled labor analysis, we will have the product, hours per unit, total hours. Sarah, I hope now you're able to see. Is that so? So when we go to product A, what we shall do is the labor for installation, you can see it is 24. So you say 24 divided by 8 is how many hours? Give me the answer. Yeah, good. Give me the answer. 24 divided by 8. Good. You can see is 3. Then we go to B. B, you can see it has that 2. So that 2 divided by 8. That is 4. I think that question you'll have to complete, Sarah, for the purposes of today. Then 44 you divide by 8 is giving us what? 44 you divide by 8. Good, 5.5. Now the total hours you multiply by the units that are required. You can see in information 4, A requires 2,000. So you will say 2,000 times 3. 2,000 times 3 is what? Yeah, 6,000. Then this other one is 3,000 times 4 is equal to what? 12,000. Then this other one is 1,800 times 5.5 times 5.5. That is 9,000. So I would like you now to give me this total. And this total required. That is total required. Total required 6 plus 12 plus 9. Is a total of what? $27,900. Why do you have 900? Oh, this is 900. Okay, 99. So this is 27,900. Now this one you compare with what is available. You compare with what is available. What is available according to information 1 is 25,000. Is 25,000. So that tells you that the deficit or the shortfall is 2,900. The deficit is 2,900. That is the shortfall. Okay. Now we are told to get the optimal production mix. The optimal production mix. Now, in getting optimal production mix, we start by preparing the first principles analysis table. We call it the first principles analysis table. First principles analysis table. First principle analysis table. Inakuanga na column called details. The column called details. There is another column called contribution margin. Contribution margin. Rather, another row is a row now. Contribution margin. Then there is another one called key factor per unit. key factor per unit. Key factor per unit. Then there is another one now called contribution margin. Contribution margin per unit of key factor. Per unit of key factor. This is what we have said is normally used in making the decision. Per unit of the key factor, and then we rank. And then we rank. And then we rank. So let's start with product A. Product A. We have just finished the issue of CVP. Yes, Catherine, welcome. We have just finished the issue of CVP, and we know that contribution margin is the selling price minus the variable cost. So what you're going to do, ukianza kwa A, utachukua hiyo selling price 250, you minus all those costs. So sema 250 minus 16 minus 24 minus 40 minus 70, and give me the answer. Yes, good. Achieve, we have 100. Let us go to product B and do the same thing. Product B and do the same thing. You take that selling price. You subtract those variable costs. You take that selling price and you subtract Sarah, yeah, you can see that is 103. Let us go to C. Take that selling price, subtract. Here's 163. We have 163. So what you do from there now is to bring the key factor per unit. The key factor per unit, they are these hours that we had computed here. So A, we had 3, B, we had 4, and this one we had 5.5. 3, 4, and 5.5. Sasa, what you need to do here is to divide. So give me 100 divided by 3. 100 to divide by 3, that gives us what? That 3.33. That 3.33. I have 103 divided by 4. Yes, security. 103 divided by 4 is 25.75. Good. I have 163 divided by 5.5. $29.64. 29.64. So when it comes to ranking, you now prefer the one that has the highest contribution margin per key factor. So this is number 1, this is number 2, and this is number 3. Number 1, 2, and 3. So after you have done that, it is now time to draw the allocation schedule. So the allocation schedule is drawn like this. Allocation schedule. So the allocation schedule, we start here with rank. We start with rank. Then we have product. Then we have maximum demand. Then we have the key factor. The key factor we have per unit. We have the available. Or I should start with the required. Let me put it this way. Required. Then we have the available. Then we have units made. And then we have key factor used and left. Once you finish drawing, you write finish. Yeah, Sarah has finished. Achille, Unity, Catherine. Good. See, Catherine has also finished. So let's record. This is rank number 1, 2, 3. So the product that is number 1 is product A. And product A has a maximum demand of 2,000 units. And according to our workings, each unit requires 3 hours. So if you multiply 2,000 by 3, you get 6,000. That is what we require. And the available number of hours, we know they are 25,000. So because the available is more than what we require, it means we can afford. So we will make all the 2,000 units that we want. And in so doing, we will have used 6,000 and we will be left with us 19,000 hours. We'll be left with 19,000 hours. Let us go to number 2, which is product C. Product C is number 2 according to our ranks here. Product C has a demand of 1,800 units, and 1 unit requires 5.5 hours. And when you multiply that, you are able to get 9,900. 9,900. And then from there, you are able to say the available is 19,000. The available is 19,000. Then you can afford, because what you require is less than what is available. So you make all the 1,800 units. And in so doing, you will have used 9,900. And you'll be left with 9,100. You'll be left with 9,100. So when we go to number 3, it is product B, which is having a demand of 3,000. A demand of 3,000. And the key factor per unit is 4 hours. So that means we must have with us 12,000. We must have with us 12,000. And then the available is 9,100. So that means we cannot afford. So if we cannot afford, what you do, you take this 9,100, you divide it by 4. You have to do how many units we can make. So the 9,100 hours available, you divide by the hours required per unit. So divide by 4 and tell me what we will get. 2275. So we can make 2275. You have to go to Betumia 9,100, and we are left with 0. We are left with 0. So that is how you make the product mix. So optimal product mix, optimal production mix. If you want to summarize it, you will tell us that we have a product here, and then units made, product, and the units made. So product A, we are making 2,000. Product B, we are making 2275. And product C, we are making 1,800. We are making 1,800. So that is what we call the actually, you can add another column here for the contribution. You can bring the contribution here so that it helps us also compute the profit. Aching, what do you mean by 6075? Oh, you have added. Okay. So now I can see that. Although it's not necessary to add. Good. So now for the contribution, it will be 2,000, and each one to go to the contribution of 100. So that is 200,000. That is 200,000. Then for B, it is 2275 multiplied by 103. 2275 multiplied by 103 is how much? $234,325. 234,325. Then this 1,800 multiplied by 163. Multiplied by 163. $293,400. 293,400. So you can say now total. Give me the total of that. Total of the three contributions, 727, 725. 727, 725. Then you say fixed costs. Now fixed cost is 450,000. So you less it. And when you less it, you get net profit. Less that and tell me what is the net profit. $277. 725. Okay, so that is how you compute the maximum profit. So the next thing is, suppose that an increase in the labor rate per hour to shillings 12 for the highest skilled installation labor would provide adequate labor at maximum demand. Determine if it is worthwhile to increase the labor rate. Now, right now you can see what has happened is that we were not able to make all the units of B. We required 3,000, but because we had a shortage of hours, we were only able to make this. So if we increase the salary by 4 shillings, if we increase the salary by 4 shillings, we are going to have all the hours that are required so that we make the units that we require. So that we make the units that we require. So that we make the units that we require. So utaandika hapo after salary increment. After salary increment. After salary increment, I'm going to have product here, units made, contribution margin per unit, contribution per unit, and total contribution. So what will happen is this. For product A, we will be able to make 2,000 units as usual. But the contribution margin will go down from 100 because that was the current. Will go down by 4 shillings per hour. And you remember, product A had required 3 hours. Because when you increase labor, profit goes down. So give me the new contribution margin per unit. 100 minus 12 is what? $88, good. So that means you will now have 2,000 times 88. 2,000 times 88. $176,000. 176,000. Let us go to product B. So B now, we will make everything that we require. The 3,000. But the contribution margin will come down from 103 by 4 shillings per hour. And you can see here we required 4 hours. So 103 minus 4 by 4. Is 87. So if you say 3,000 times 87, 3,000 times 87, $261,000. Then we go to product C. We are making 1,800, and this goes down 163 minus 4 times 5.5. $141. So sasa utasema 1,800 times 141. 1,800 times 141. $253,800. So with that now we have the total. We need to get the total of those three. $690,800. $690,800. Then we bring the fixed costs as 450,000. 450,000. So that we have the net profit. Net profit. The backing up. Oh, you already have the answer. 248,800. 248,800. Good. So what do you advise? Should we increase the salary? You compare now this profit you were now before the increase and what now we have gotten after the increase. What do you advise? Should we increase the salaries or we should ignore? Yes, we should ignore. We should not increase the salaries because you can see when we increase the salaries, the profits are coming down. The profits are coming down. Good. Let me look for another one. The next one that I want us to handle is May 2012. Question number, go to page 97. Go to page 97. So I'm saying the question is on page 97. It is a question of May 2012. As question 3. And we will just confine ourselves to the product mix decision. So the question reads that Hekima Limited produces 3 products, namely X, Y, and Z. The budgeted production costs and selling prices for the first quarter we are given there. Variable overheads are covered at the rate of 150% of direct wages. Fixed overheads amount to 5 million. Direct labor hours in Department 1 are in short supply and budgeted volume of output envisages full utilization of the available labor hours. In Department 2, the company has committed to engage the workers to the extent of the direct hours required for the budgeted volume of production. In the event a product mix change is desired, the company will engage additional direct labor hours required in Department 2 at normal rates. Any such surplus labor hours will be paid as idle time. So number 1, you are told to come up with a statement of budget profitability. A statement of budget profitability. So statement of budget profitability. So in this statement, we shall have details. And details, I shall start with selling price. Now, selling price, we shall say less variable costs. We less the variable costs. The variable costs that are present here, we have direct materials, we have direct wages, and direct wages, we have department 1 and department 2. Then we have overheads. Overheads as well. We have department 1 and department 2. Department 2. So when we do that, we will get a figure we do so well called contribution margin. Contribution margin. When we get the contribution margin, we shall bring total units. Then we shall bring total contribution. So tutaifikisha hapo kwanza. We have 3 products. So we start with product X. As you can see, huko chini, the selling price is 750. Material is 240. Labor in department 1 is 40 times 3. That is 120. In department 2, it is 20 times 3. That is 60. Alafu tukienda kwa overheads, tunaambiwa overheads are 100% in department 1. So 100% of this 120 is 120. And they are 50% in department 2. So 50% of these 60 is 30. So give me the contribution margin per unit of X. Contribution margin per unit of X. It is 180. And the total units as per the budget, the budget production is 10,000. So that means the total contribution will be 1.8. The total contribution is 1.8. Let us go to Y. Let us go to Y and do the same thing. The selling price is 10.50. Material is 160. Labor in department 1 is 40 times 5. 40 times 5 is 200. Department 2 is 20 times 8. 20 times 8 is 160. Overheads najua hapa kwa department 1 100%. Sio itakuwa 200. Department 2 is 50%. So that is 80. So give me the contribution margin of Y. Or 250, good. 250, and the units are 12,000 as per the budget. So 12,000 times 250 is how much? $3 million. So with 3 million, sasa we go to Z. We go to Z. So Z, the selling price is 600. 600. The raw materials are 120. Labor is 40 times 2.5. 40 times 2.5 is 100. You're given 20 times 6, that is 120. So overhead, 100% of 100 is 100. And 50% of 120 is 60. So give me the contribution margin. $100. So if it's 100 and the budget production is 20,000, that means we have 2 million. We have 2 million. So maximum profit or net profit below that will be now 1.8 million plus 3 million plus 2 million. You minus the fixed costs. The fixed cost, we are told it is 5 million. So that is the so that is 1.8 million. 1.8 million. 1.8 million. We are told to get the optimal production mix. Optimal production mix. So for us to get the optimal production mix, First of all, we will need to know, we need to have analysis for labor hours. Analysis for labor hours. We have details. We have the budget. The budget. And the maximum. Let's call the maximum. Maximum. So in this case, we have product X. Product X, right now in the budget, our figures are in thousands. Our figures are in thousands. Product X, according to the budget, is 10,000 units. And one unit is taking us, I should have divided it further. I don't know whether you have space because we have two departments. We have two departments. So that here in department 1, have you drawn? I design it again. I design again, or we continue that way to show department 1, here department 1, here department 2. Can we continue that way? Or we design again? Okay. Okay. So let me even wrap here so that I don't struggle with space. So that I don't struggle with space. So what you're saying, we are doing analysis for the labor hours. Analysis for labor hours. And I'm saying here we have details. We have details. Sasa hapa kwa details. So here we have budget sales, and then we have maximum sales. So this is department 2, this is department 1, department 2, and department 1. Yeah, that is what I wanted. Are we there now? Kama umefikisha hapo, sema yes. Yes, Achille. Yes, Sarah. Unity. Good. And I want to work with our figures being thousands. Our figures being thousands. So we begin with the product X. Product X, in the budget, we have 10,000. And it requires 3 hours in department 1. So that is 30. In department 2, we have 10 units, each requiring again 3. So those are 30 hours. When you go to the maximum, X will require 12,000. So 12 times 3 is 36. And 12 times 3 also is 36. That is as per the maximum. Let us do the same for product Y. Product Y in the budget, we have 12,000 units. And each requires 5 hours. So that is 60. That is 60. In department 2, these 12,000 each requires 8 hours. That is 96. 96. When we come to the maximum, we require 16,000 units. Each taking 5. That is 80. Then we have 16, each taking 8. That is 128. 128 hours. All right, let's go to Z. When we go to Z, we have 20 at 2.5. That will give us 50. Then we have 20 at 6. That will give us 120. So when I come here, this is 24 at 2.5. That must be 60. And then here, 24 times 6. 24 times 6 is 144. So we get the total. Ukichukua calculator hii ya kwanza utasema ni 30 plus 60 plus 50, you get 140. Huyu mwingine ni 30 plus 96 plus 120, you get 246. 36 plus 80 plus 60 is 176. 36 plus 128 plus 144 is 308. So those are the totals. So with that now, we are already told by information 3 that direct labor hours in department 1 are in short supply, and the budget volume of output envisages full utilization of the available direct labor hours. So in department 1, this is what is available. But you see, for the maximum, this is what we require. So that tells you there is a shortage. The same thing with department 2 here, because you can see we have 246, but we require 308. However, we are told by information 5, that in the event a product mix change is desired, the company will engage additional direct labor hours required in department 2 at normal rates. That means that in case we require more than 246, we shall be able to get what we require. So department 2 is not a key factor. So if that is true, let us now proceed and prepare our preparing from the reverse because I want to use the upper space in Ishara. So hapa we have the run, and here tumesema we have contribution margin per unit of key factor, Then we have key factor per unit here. Then we have contribution margin. And then this is details. And this one we are calling it analysis table. So we have product X there. We have product Y there. We have product Z. So I think contribution margin, was it 180, 250? Hebu niandikie those contribution margins the way they were. Oh, 100. Ya mwisho ilikuwa 100, yeah? Okay. $180, $250, $100. Good. Key factor, we already have said, that it is here, department 1. So department 1, you can see X is using 3 hours, Y requires 5 hours, and Z requires 2.5. So divide 180 by 3. Divided by 3, 60. 250 divided by 5, 50. 100 divided by 2.5, 40. So in terms of ranks, this is number 1, this is number 2, and this is number 3. In terms of ranks. So from there, let us now draw the allocation schedule. The allocation schedule. So the allocation schedule, we begin with the rank. We always begin with rank. Then we have the product. Then we have maximum demand. Then tukuje hapa tuseme key factor. So key factor, we have per unit. We have the available. Sorry, we have the required. And then we have the available. Then we have units made. Units made. Then from there, we have key factor. Key factor that is used. And then left. So are we there now? There's a chain. There's Sarah. Yes, profitability. So let's start with number one. Number one is X. And the maximum demand for X is 12,000. And the hours required are 3. So that is 36,000. I want you to go back to the table that we have drawn for the analysis of labor hours and tell me the total for the budget in Department 1 was what? The total in the budget, tulikuwa tumepata nini? For Department 1. Is it 176 or 140? Hiyo table tulikuwa tumechora. Okay, 140. So I think 140,000. So if it is 140,000 and we require that seats, then we can afford to make all the 12,000 so that we're tumetumia 36,000 and you are therefore left with one with 4,000 hours. You are left with one with 4,000 hours. Haya, twende kwa product number 2. Product number 2 is Y. And the maximum demand for Y is 16,000. and Y requires 5. So that means total required is 80. And with us, we have 104. We have 104. So sasa hiyo 104 is enough to make the 16,000, so that we will have used the 80,000 and we are left to deal with 24,000. 24,000. Then we go to number 3, which is product Z. Number 3, which is product Z. Now, product Z, according to our maximum, it is 24,000. 24,000. So 24,000, each requiring 2.5. That means we require 60,000. But we have with us already 24. So this 24,000 can be enough to do how many? 24 divided by 2.5. 24,000 divided by 2.5. It is 9,600. So we will have used the 24,000 and we are left with 0. We are left with 0. So the product mix is already done there. You don't have to keep on extracting it like we did. You can just leave it there. There is something else that we require here. Department 2 hours used at Optimality. Used at Optimality. Department 2 hours that are used at Optimality. We will have 12,000. These are the units of X. Na kwa department 2, X inahitaji 3 plus huyu mwingine ni 16,000, that is Y. Na Y inahitaji 8. Then hii mwingine tumesema ni 9,600, and the each is taking 6. So multiply to 21,600. 21,600. Then from there we will have idle hours in department 2. Idle hours in department 2. Now the question had said that we are going to avail what is available in the budget. So nataka unisomee what we had gotten in department 2 as the total under the budget. Tukiwa kwa budget, department 2 ilikuwa na total ya what? In the analysis for the labor hours, it had a total of 246. Okay, so these 246 hours will be available, but you can see we are only using this. So subtract 221,600. 24,400. 24,400. 24,400. So that now, below that, we can get maximum profit or income statement at Optimality. Income statements at Optimality. So the income statement at Optimality, we will have a contribution. So this contribution, let's start with product X. Product X, we are making 12,000 units, and each one has a contribution margin of 180. So multiply and give me the answer. Let's be fast now. Not time in the soccer. Almost 12,000 times 180 is what? $2,160. 2,160,000. Let's do the same for product one. We are going to make 16,000, each at 250. Each at 250. 16,000. $4 million. This is 4 million. Then Z, we are going to make 9,600 units, each at 100. So that is 960,000. So with that, we can be able to get total contribution. Total contribution will be 2,160 plus 4,000 plus 960, which is 7,120,000. That is the total contribution. Then you less idle time costs in department 2. In department 2, the idle time costs in department 2 is going to be given as 24,400 hours, and each one we are told is paid at normal rate. Normal rate in department 2 is 20 shillings. So ukasema 24,400 times 20 is 488,000. 488,000. So we are subtracting that. There should be fixed costs. Fixed costs, the question tells us clearly that it is 5 million. It is 5 million. I think those are the only costs. So with that, we have the net profit. Net profit You should say 7120 minus 488 minus 5,000 is 1,006,000. So that is the profit that you will get at Optimality. That is the profit that we are going to get at Optimality. And finally, the minimum charge that should be put per direct labor if the company desires subcontract. So that one is on a special pricing decision, which is what we shall do in the next lesson. Special pricing decision. And in special pricing decision, we normally say that the minimum price should be equal to the relevant cost. Should be equal to the relevant cost. So the minimum that these guys should pay us is number one, the 20 bob that we are paying our workers in department 2, and then they should pay us the overhead, which are 50%. So 50% of 20, and that gives us 30 shillings. So the minimum they should pay us is 30 shillings. So we call it a day at our juncture, and hope to meet in the next lesson when we shall discuss now special pricing decisions. Not about the product mix. Make sure you revise well. Thank you. Have a nice weekend.